How do central banks use optimal control for inflation? Imagine steering a ship through unpredictable waters, trying to keep it on course without overcorrecting. That's similar to how central banks manage inflation using optimal control. They aim to keep inflation close to a target, usually around 2%, while supporting economic growth. To do this, they use a framework called optimal control, which helps decide how to adjust policies like interest rates over time. The process starts with the central bank setting a loss function. Think of this as a way to measure how far inflation is from the target and how much the economy is deviating from its potential. The goal is to minimize this loss, balancing the need to control inflation and keep the economy stable. The central bank then uses economic models to forecast how changes in interest rates will influence demand and inflation. Using these forecasts, the central bank solves an optimal control problem. This helps them develop a rule for adjusting interest rates based on current and expected future inflation and output gaps. For example, if inflation is predicted to rise above the target, the bank might raise interest rates to slow demand and prevent inflation from spiraling out of control. Conversely, if inflation is below the target or the economy is weak, lowering interest rates can stimulate demand and boost growth. The transmission of these policies takes time. When interest rates change, they first impact how much people and businesses spend. After some lag, this affects inflation, which depends on the difference between actual output and its potential. Central banks also pay close attention to inflation expectations because if people believe inflation will stay stable, it helps keep actual inflation steady. They communicate their goals clearly to anchor these expectations. When expectations are well anchored, it reduces the risk of wage and price-setting behaviors that could push inflation away from the target. The optimal control approach is flexible, allowing central banks to adapt to different situations, like temporary supply shocks. If inflation rises due to a supply disruption but is unlikely to last, the bank might look through it. But if inflation risks becoming persistent, they might tighten policies more aggressively. Overall, optimal control gives central banks a structured way to plan their actions. It helps them balance the need for price stability with supporting economic activity by making informed, forward-looking decisions based on models and forecasts. This method is key to modern monetary policy, emphasizing transparency, credibility, and the importance of expectations in controlling inflation.